Let me introduce the panelists. So all the way over on the left is Meg Mcconnell. All of these people here had important jobs during the crisis, and you can read their bios. I thought I would just say a little something that you may not see in their bios. Meg now runs a fantastic, tremendously interesting group at the New York Fed called the Applied Critical Thinking Group, which is unique in the world in how it is, I think, doing great things to help us prepare for the next financial crisis. We make great use of their knowledge and services in our program at Yale, and they've been tremendously helpful. Please don't stop doing that, Meg. Matt K. Baker was at Treasury the same time that I worked briefly for the government. I wasn't a lieutenant. I was a corporal or private first class or something like that. And I got a chance to work with Matt a lot, which was tremendously impressive. Great intuition. His first instincts were often better than my well-thought-out third and fourth instincts. It really angers me that he's such a terrific economist without having spent any of that annoying time getting a PhD. Michelle Davis had, as people know, many important jobs working in Treasury in the worst part of the crisis. People also know that she was portrayed by Cynthia Nixon in Too Big to Fail. With Cynthia Nixon moving now into government, I have confirmed with Michelle that her career in the theater will be taking off. And immediately to my left is Bill English, who is now, I am delighted to report, my colleague just down the hall from me at Yale, where he is teaching our students central banking and monetary policy. And it's been fantastic for me because he knows so many things that I don't know and wish I knew, and I can ask him questions. It's not been as great for Bill because he looks around and does not see 350 staff members who can do all of his work for him. We're going to start with Meg. Take it away. You have to press a button, I think, but which button it is, nobody knows.
Matt knows. Yep, exactly. Good first instincts. Okay, so I wanted to start with a quick, two quick disclaimers. The first is that the views I'll express are my own views, not the views of the Federal Reserve Bank of New York or the Federal Reserve System. I am not on garden leave, so I probably have to be more careful than Bill was. And second, that the area that Andrew mentioned, applied critical thinking that I'm running at the New York Fed, it kind of calls me to make another disclaimer, which is the assignment we were given was to write a paper on the interpreting the evidence from the outcomes from the responses to the crisis. And I think I just want to, maybe state the obvious, which is it's probably a little fraught to try to interpret the evidence on outcomes, both because the system is complex and the outcomes we're seeing are a product of many forces and not just the policy actions, and also because we're looking at all this through the lens of hindsight, and we probably are oversimplifying what we were understanding in real time and what was obvious and what was predictable. And the last bit of that is just that there's a tendency maybe towards outcome bias to think that the things that worked out well were good decisions and the things that worked out badly were bad decisions, and that's probably not a lesson we would want future crisis managers to take, because you don't control the outcomes, you just control the quality of the decisions. Okay, all that said, the framework that we used to look at the evidence on outcomes was to try to organize the actions into two types. But I think that Andrew and Nellie covered this, but quickly I'll just mention macro actions that are designed to support economic activity and spending. These are things like, changes, countercyclical monetary policy, fiscal policy, and the measures that we looked at to see how the quality of those outcomes are: real GDP, employment, bank credit. On the systemic side, we talked about actions that were taken for the purpose of preserving or restoring the functioning of the financial system. We called those systemic policy actions, and those are things like liquidity provision, capital injections, debt guarantees, et cetera. And the measures we used here to look at indicators of outcomes were LIBOR OIS, CDS premiums of banks, and mortgage spreads. Okay, so and then we also thought about the crisis in three different phases, and the first phase being from 07 to March of 08, and the conditions that people were seeing in real time. really were characterized, we think, by kind of challenging but manageable. There wasn't a sense that it was approaching any kind of catastrophic situation. The economy was slowing, and there were strains in financial markets, and I think there were concerns about undermining the efficacy of the transmission mechanism due to those strains. And so the outcomes, the policy actions that were taken during that time, if you sort of read back in real time, were around preserving or restoring the functioning of the financial markets, keeping the transmission mechanism working, as well as addressing foreclosures. So, and then from the second phase, we said from March '08 to September '08, we're characterizing as broader uncertainty and deeper concerns. And so the recession was still seen to be shallow at that time, but there was growing concern, at least in some quarters, about a negative feedback loop between what was going on in the financial sector and what was happening in the real economy. And there, I think the policy actions taken during that time were around supporting economic growth and preventing a further deterioration in market functioning while we kind of waited out this housing adjustment. And then the third phase, from September '08, really middle of September '08 to the end, we're calling panic. The conditions were closer to panic. And the concern there was an outright depression that was being sustained by a full-scale collapse in the financial system. And the types of outcomes that we were seeking to alleviate during those times were run dynamics, panic dynamics, contagion, things to sort of conquer the generalized uncertainty that was maybe crippling the functioning of the system. So the way we approached this was to look at the wide range of literature that's been done on trying to document some of the outcomes associated with the crisis responses. And I think we drew two overarching conclusions. And the first really is that that given the severity and breadth of the strains that the financial system was experiencing at that time, and the scale and scope of losses and the uncertainty around how those things would play out, the outcomes on the economic front, the overall outcomes, were not as bad as you might have expected based on historical experience. If you extrapolate from the size of the shock to the system, you might have expected something more on par with the Great Depression, and that's not what happened. And so one conclusion you could draw from that, again with the caveat of complexity and notwithstanding, is that the mix of actions taken in response to the circumstances, the escalation from more traditional policy responses to some more innovative responses that were tailored to the disruptions that were manifesting in the markets and in institutions at the time, into what I guess we would call like the definitive actions of recapitalization and debt guarantees. That progression did play a role in keeping what was a very, very severe problem in the financial system from turning into a depression. So that's one conclusion. And then I think the second broad conclusion is that that we, how am I doing with time? I have no idea what I'm supposed to be, what's that mean?
You're fine.
Oh, good, okay. It's moving, but, okay, so I'm not really sure where the mark is, so I'm just, okay, so the second conclusion really is that even though, yes, we can say that about those actions, we did have a very severe economic downturn that caused a lot of damage to a lot of households and businesses for a long period of time, and a recovery that was slow. And so things were still bad. And so we kind of grappled with, well, how do you reconcile the fact that the escalation of policy measures feels like there was, the mix of policy measures was about right. And I think so we tried to interpret why is that? Why is it that it was still so severe? And I think, one reason would be that the conditions leading up to the crisis were also severe. There was a severe misallocation of resources in the lead up to the crisis associated with the housing bubble and the financial role of the financial markets in that. And then I think the second reason is that we speculate is that the definitive actions, the injections of capital and the use of guarantees came only after the conditions of panic and the real kind of contagion in the financial system was well underway and was visible, and without, there was no debate that this is what was going on, and that maybe by that time, the damage to the system, to future output, future output outcomes had already been done, that there was a certain amount of damage baked in by the time you get to the system functioning in the way that it was, that warranted finally the action on TARP, which allowed for the capital injections, and the capital injections were a complement that allowed the guarantees, the use of the FDIC authority to do the guarantees. So, our conclusion there is that maybe the timing of that was, had an impact on what was even possible by the time we got there. And so then what we did with overall in the paper was look for some kind of what our lessons learned. I had to put this in quotes because I do think everything we call a lesson learned is not, generally not. So but that's what we were calling it. So the lessons we've learned. So you should prepare for what's likely. Financial crises are going to have certain characteristics, things that look liquid in any circumstances will be the things that turn out not to be liquid. The institutions that are well above any kind of regulatory capital ratios or well capitalized will turn out to be the ones that are not well capitalized. And the firms that are not systemic will be systemic, right? So that there's certain things are going to happen that you need to practice responding to, and you've heard that, I think, over the course of the day. The second thing is to prepare to be surprised. So I was thinking, that people in the future, when they're, another one of these conferences in 20 years or something, they'll look back on what we talked about here, and to use another Tim word, they'll think it's quaint. And I looked that up, and so it means attractively unusual or old-fashioned. So, what aren't we talking about here that's going to be the thing that is in the next crisis? And so just thinking, and this also came up earlier, how do you think about the stuff you haven't seen yet, but that you could see, and try to understand how you might respond? I think organizations should try to develop their capacity to adapt and learn in real time all the time and not wait for a crisis to do it. Third lesson, communicate before, during, and after a crisis. So talk to the public about what the financial system is doing, what it's supposed to do, and what kinds of principles will guide your intervention in a crisis. And fourth, just recognize that there's always going to be forces that push against early intervention, and that in real time, when the things that we now look back and say they were too slow, they came too late, there were a lot of people or forces, or there was a lot of energy towards it not being too late yet. It was just right, or if not early. So recognize that it's not, that what we see with hindsight as to how could we have not done it sooner is not really what's going to be experienced in real time. There'll be concerns about moral hazard, concerns about signaling adverse information. There'll just be sheer uncertainty, lack of confidence that you understand what to do. All those things are going to cause you to move more slowly. And then I think the big thing for people to think about in that context is that we should look for where we've built in triggers that are too late ex post into the crisis response tools that we have now, and look for ways to maybe try to counter that bias towards inaction that I think is inevitable. And so it doesn't need to be inevitable, hopefully. Okay, so fifth one is late intervention limits the potential for good outcomes. That's the earlier point, that if once the system is disrupted, you don't get it back. You can't make up that lost ground. If you believe the financial system matters, it matters that it's disrupted for a period of time like that. The sixth is that late intervention may raise rather than lower the potential for unintended consequences. So you delay because you don't want to create moral hazard, and you delay because you don't want to signal adverse information, and then you have to go, somewhere more extreme that is more shocking to the system and maybe creates greater sense of unfairness. So that's, I think, a thing that is a part of managing this. So 7 and 8 are linked. Just 7 is that you do need a strong regulatory and supervisory structure to reduce the probability of a crisis and the impact of a crisis on the economy. And then 8 is that a strong regulatory and supervisory structure is not a substitute for good crisis management, and that we shouldn't lure ourselves every time we hear ourselves, well, the system does have more capital now, but we're not talking about that. We're talking about when it's in a crisis. And so that's the quality of the system you have is not a reason not to prepare for the problem. And so those were our lessons. That's it.
Thanks very much, Meg. I have sort of come down the panel here a little bit. Thank you. Really? I need the microphone? Okay. I'm going to come down the panel a little bit and ask Matt. Matt, you came from the private sector, came and did your duty in government, and then you went back. One way to measure outcomes is the empirical way, which is what Meg has been telling, but there are other ways. And one thing I'm curious about is what do our friends and enemies in the private sector think of the job that government did? How is it talked about when the cameras aren't on? And you can tell us, and we won't tell anybody you told us.
The camera is on, though, Matt.
Right.
You want me to tell you what the entire private sector thinks of
Correct.
the response? Okay.
Correct. I want you to represent
Yeah.
the private sector.
Yeah, I was asked that a lot when I was in government. There was a desire to have the private sector support a variety of things that we were announcing, and I was sort of asked to make sure they rally behind it. It turns out it's not sort of a thing, more of a... so I think there was not unanimity in how they viewed the response. I would say they probably preferred it to the alternative. And I would also say I think there's probably a longer tradition in this country of having some skepticism of government involvement in the private sector, and I think there was a belief both in 2008 and 2009 that perhaps that was changing, and there was going to be maybe more permanently a government presence, at least in the financial sector, or perhaps more broadly the auto sector comes to mind. And I think the speed at which both administrations, committed to exit, I think definitely is something that I think I've heard, a bunch about. And that reinforced, a tradition of having the government pull back from that involvement, which is not the case in a lot of other countries. So I think that's sort of an interesting thing that tradition actually managed to survive the crisis response.
Thank you. Thank you. One outcome which we have not measured, but we don't need to measure because it is apparent, is that the public reaction to the things that were done was tremendously negative. That there's been a lot of backlash, perhaps a large change in the political systems across many countries, in part due to what was done during the crisis. And this is not unusual for history. So, Michelle, you had a hard job during the crisis of trying to help not just form the policies, but communicate them. And I wonder if there is anything that we can do in a crisis to have a better outcome in the way the public sees it afterwards.
We did some incredible interventions that were wildly viewed as un-American, as Matt said. That should be unpopular, right? We don't want that to become like, oh yeah, let's just do that again. That would be bad. It should be very politically difficult to do some of the things that we did. So the bar needs to be high. And I think that's something really important to pass on. I mean, in these policy papers that everyone's been writing all day and passing on to future treasuries and Fed who face these kinds of crises, we need to be very clear that winning public opinion should not be your measure of success, because that you're setting yourself up for failure. The audiences that we needed to reach, we did, because we focused on the audiences that we needed to be with us and help us get the system restored as quickly as possible. So, and I think that is really the lesson to me, from a communications perspective, to pass on, that there were a couple of things that were absolutely critical to being able to communicate confidence, right? Because all of this was about trying to boost confidence, eliminate uncertainty, and oftentimes we were announcing policy things that were going to take some time to put together, and you needed the confidence to be there, that not only that it was the right idea, but that we could actually execute it. We had the leaders in this crisis, Hank and Ben, every time they announced something, that was there. Everybody trusted them and believed that they had come up with the right thing to do and they could make it happen. We kind of took that for granted probably at the time, but now I don't know if you should take that for granted. And then the second thing that was so foundational to being able to communicate and raise confidence was speaking with one voice. There was never light between us and the two institutions, and because you two were on the same page, and then within our administration, there were no voices raising doubts about what we were doing, and that also gave some certainty that when we said something, we meant it and it would happen. Those foundational pieces were really important, so that when we did make all these innovative policy announcements, they were met with, "Oh yeah, good. Well, that's that. Well, we'll see. Maybe that's a little odd, but we'll give the benefit of the doubt." Among the people who mattered, the policymakers in Washington and around the world, and financial market participants. Public opinion, it would be great, but you don't. When you're trying to put out, use Tim's fire analogy, when you're putting out the fire, you don't have time to explain how the fire extinguisher works. We tried to talk about the banking system as the plumbing of the economy that makes all these other things happen, mortgages, jobs, but that is not going to resonate in the middle of a crisis like that.
Thank you. So Meg has focused on Meg has focused on the actions taken during the crisis at the worst time to stem the panic. And that's one important set of things, and that's what she was asked to do. But there's been a long tail of reacting to the crisis, much of it through monetary policy. And so I just will put Bill on the spot. We heard a little bit of this from Don, but you don't work for him anymore. So now you can say what you really think. In your completely unbiased view, how would you evaluate the outcomes of the monetary policy in the many years since the worst part of the crisis?
So not surprisingly, I think on the whole monetary policy did pretty well. So I'm in agreement with Don and Brian's paper. I think the Fed in particular was a brave and effective institution in turning to unconventional policy. I think that was not obvious, that those policies would be used as aggressively as they were. I think other central banks looked to the Fed to kind of lead the way on a lot of those tools, and I think those were pretty effective. I mean, as Ben Bernanke always said, the monetary policy helped. It was valuable, but it was not a panacea, and I think that's right. There's a nice paper by Engen, Laubach, and Reifschneider a few years ago where they go through and try to add up all the pieces. How much was unconventional policy worth? And they end up saying, gee, the maximum effects of the unconventional policy was something a bit less than 1.5% on the unemployment rate, something like 0.5% on the inflation rate. So this is useful, right? That's a couple million people who had jobs who wouldn't have had jobs, and inflation that is significantly closer to target. But nonetheless, not a panacea for sure. We still had a very long and kind of halting recovery. I think there were three constraints on policy. One that's discussed nicely in Don and Brian's paper is the forecasting problem. I think it was a surprise kind of how big the effects on output were. Also just how bad the crisis got. I mean, coming in, as somebody said this morning, there was a lack of imagination. We really didn't understand kind of how bad things could get. And so it was hard for monetary policymakers to see how bad it was going to get and to move kind of in advance of the problems. Another constraint was just the limitations on the effectiveness of policy. Our estimates of the effectiveness of monetary policy are, it's not that powerful a tool. We got to the zero bound, or more or less, and then large-scale asset purchases only work if they're really big. And so policy isn't that effective, and so I think it was hard to provide as much accommodation as we would have liked. And then the third constraint was, I think the committee really was learning over time. They were learning about the effectiveness of policy, but more importantly, as Don and Brian emphasized, about the costs and risks, and how hard or how risky was it to push these policies further? How big a problem were you creating for yourself later in terms of inflation, in terms of financial market functioning, in terms of financial stability, in terms of exit? And I think the committee, as a result, kind of took smaller steps to see how would it go, and how comfortable would they be, and how much further could they go. So a key lesson, I think, coming out of this is those risks and costs mostly didn't eventuate. I think that doesn't mean they could never do so, so you don't want to ignore them, and policymakers should think about them and monitor for them. But I hope if there's a next time, first I hope there won't be a next time, but if there's a next time, I hope that the Fed could move much more rapidly and much more aggressively to address the slowdown in the economy, to provide a bigger offset.
Thank you, Bill. We did get a question from the audience, and this is a question for you, Michelle. And I think that while this question was being written, you kind of answered it. So I'm going to read the question anyway, and then I'm going to put a little addendum on the end in case you think you've answered it, because I think maybe you have. So there's one frequent policy criticism involves communications policymakers did not adequately explain to the public, which is underlined twice, why they undertook measures that seemed unjust, like, for instance, bailouts, and that communication failure led to the populist anger on the right and left that gave us, among other things, our current president. Do you agree? What are the lessons learned for the next crisis? And the addendum here is something we didn't do, perhaps in an attempt to have more legitimacy, something our friend Paul Tucker tells us all the time maybe we should do, is get the President of the United States out in front of it, like FDR was, giving a big speech that explained why we were doing what we were doing, that not just the technocrats, but perhaps the elected officials. And I wonder if, did you consider doing that, trying to get that done? And you can, I realize, only answer for one of the administrations, but perhaps speculate as to whether it might have worked for the others, or anyone else can. What do you think that on this question and the addendum?
Okay, that's a lot.
There you go. Well, we have at least 4 minutes, so you should be fine.
Right. Yes, it was horrible to sit and watch the news and see that every day the story would be pictures of foreclosure signs, interviewing a family that was losing their house, and then quick cut to a bunch of white guys in suits talking about putting capital into banks, and that's going to fix it. I mean, it just is a complete disconnect for anybody watching television. We could have spent, well, we would have had to hire like armies of people, but we could have spent hours and hours every single day trying to walk through how the financial system works and how the capital in the bank is actually what gets out into every other part of the economy. I don't even know that if we had done that, I don't know that it even would have penetrated, because we were so busy taking so many actions, and everything that we were doing was news in and of itself. There was no time to even try to explain some of those things. And I love all the people who are here at this event today, and they're all brilliant, and they came up with some phenomenal solutions. But you've seen the charts that we've had up here today. Would those have convinced the public? We're not. That's not the expertise of the people we hired to fix these problems, and that's a good thing. No, I mean, certainly there are things we could have done better, and they may have made a difference around the margins. I do think, both presidents probably tried to give an air cover where they could. It's very different to be announcing a big government spending program after the Great Depression to rebuild the economy than it is to announce your letting bankers keep their jobs. I don't care who announces it or how many times they explain it, it will never be popular.
I might just add.
Go ahead, Matt.
I think it's interesting to look at other cases. So you could look at other countries which pursued different mixes of policies, and you could ask whether they had different political economy results. I'm not sure they did. I think it was sort of most of these types of actions, even if they differed on the margin, were broadly unpopular in a variety of countries. The other observation is there were institutions in the U.S. that were heavily involved in the response that emerged relatively unscathed. The FDIC being, I think, the most clear case in point, and there might be some interesting learnings about what it is about the sort of way the FDIC was set up in the 30s and then revised after the S&L crisis that allowed it as an institution to be able to do the types of things it did and emerge as an institution with a lot of public trust.
Thank you. We have a few minutes left, and I'd like to ask one other question, and it has to do with outcomes, but it's something that we don't usually study or we don't have great empirical evidence on, but some of my business school colleagues do, and that has to do with teams and the effectiveness of teams. Matt, as I teased earlier, came from the private sector and went back out again. And as it turns out, many, many important contributors in the Paulson Treasury and the Geithner Treasury did that. Phil Swagel, who will be with us tomorrow, he's one of the authors on the project, told me early on in the crisis when I was talking to him, he was coming from an academic background, and I asked him, what are some things you learned? And he said, I learned that investment bankers are useful. He was very surprised to have learned that, but he said they can do complicated things very fast, and in a crisis, you need to do complicated things fast. Interestingly, what I believe to be quite successful team that we had at the top of Bernanke, Geithner, and Paulson, you have one academic economist, one career public servant who had been forged in many crises, and one investment banker. And that multidisciplinary team turned out to work exceptionally well together and have a complementary set of skills. What we study often, not me, but some of my colleagues at a business school, are what makes for effective teams. And I wonder if, I'm going to put Meg on the spot, I didn't warn her at all, but I wonder if your group, your applied critical thinking group, is thinking about that at all in terms of coming up with creative solutions or being effective at implementing them, whether there's value to putting together certain types of teams, and whether there are any lessons for us in how we should be thinking about organizing our red teams for crisis fighting in the future.
Yeah, I mean, I think there is a lot of research. Well, actually, there's ironically really just one book that really emphasizes the value of diversity, cognitive diversity. But it had a powerful influence, I think. It's called The Difference by Scott Page, and then he has a second book as well and also I think this book Team of Teams by Stanley McChrystal, and tries to get at this need in a complex, evolving problem for a diverse array of people to be weighing in and to be collaborating on solving it. That there are certain types of problems where you do want a diverse team. There are also practices that support that. I don't think it is just the diversity. I think it's the kind of norms you adopt and the way you engage with each other that are effective. And I think those were part of what went on in the crisis.
Thank you. Okay, I think I should probably turn this over for our last speech of the day. I want to thank the panel.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.